Hey YouTube, I'm Jimmy. So in this video, I want to talk about what I would invest in if I had $1,000 to start investing and I was just beginning out. Then at the end of the video, I want to talk about some things I do with my investments now that I wish I had known when I had first started that could help juice up my returns a bit. Okay, so now funny enough, there's actually a right way and a wrong way to start investing. And when I was prepping for this video, I went over and I watched some other videos that tackle a similar topic. And much of them said the same thing. Pay off your debt, then save up, and then with some excess money, go out and start investing. And they're right, that's the right way to do it. But I actually didn't do it that way. And I suppose that my spending habits early on weren't the best of habits. And a lot of that changed for me when I first started to invest. See, I actually opened my first investing account. I think it was E-Trade or TD Ameritrade, one of those, I forget. Whichever one didn't have a minimum balance because I only had about $500 to invest at the time. And I also had a car loan and I had $1,500 or so in credit card debt. Well, I'd saved up this $500 and I had every intention of paying off my credit card bills, but then I heard this story from Warren Buffett. Okay, so the story went something like this. Buffett was just starting out, or at least he'd been doing it for just a few years, and although he was a millionaire already, he wasn't worth anything near what he's worth today. And, well, he comes home one day, and he sees that his wife had gone ahead and remodeled their kitchen. She put in new countertops, new cabinets, new refrigerator, whatever it was, and he stops and he asks her, how much did this cost? And I forget what the number was. It was something like $10,000, $20,000, $30,000, something like that. And the story goes on that Buffett was annoyed and was angry that he couldn't understand why she would spend that much on remodeling the kitchen. And he explained that it wasn't the $20,000 or whatever the amount was. It was what he could have done with that $20,000. And he said that $20,000 could have been $100,000. It could have been $500,000 or $1 million. That if he had enough time with that money, it would have turned into significantly more money. So I put the $500 that I had in an investment account, and I could have paid off that, or at least part of that credit card debt, but I didn't. Instead, I put the money in an investing account and I start looking for investments. And I was worried about how many shares I could buy with just the 500. So I tried to add as much money as I could, as often as I could, because there were going to be commissions when I did it. This is before Robinhood. So I was going to pay a commission. So if I could only invest 500 or if I could only invest 100 or whatever it might be in any one position, I was going to get a commission, and I wanted to cut back on the impact of those commissions on my overall investment. And I put everything I could get my hands on into the account. I worked at New Balance at the time, so I wasn't making a ton of money, but it didn't matter. Every time I got a paycheck, I would put as much as I could into the investment account, and the rest of the time, I would spend researching stocks. And I ended up building up to just short of $1,000, about $990. And I found my first stock. It was Wyeth. Wyeth was a pharmaceutical company that was eventually bought out by Pfizer. Now, at the time, I want to say that Wyeth's shares were trading at about $30 a share, give or take. I do remember that I bought 20 shares, so we'll call it about $600. Now, at the time, I had been reading a lot about investing and learning how to invest and about options. So at the time, I thought that it made sense to go out and buy an option in addition to the shares that I bought. So I bought the 20 shares, and then I bought one call option, and that call option cost me about $180. And it expired in like 3 months from when I had bought it. Now, the shares were just short of $30, I think, and because I remember I had a $30 strike price. Well, I got a little bit lucky, and Wyeth ended up moving from about $30 a share to about $38 a share over the next 2 months. Now, my 20 shares that cost me about $600, well, they're now selling for about $760. And my options, on the other hand, well, I had paid about $180 for them, and they were selling at about $850 since it was about $8 in the money and there was still a month left. So I sold everything. Why did I sell then? I have no idea. Like I said, I was a bit inexperienced at the time. I think that the stock actually continued to go higher, but I was nervous. I didn't really know what I was doing, so I jumped up. So now I have about $1,600 in the account, which is more than what I owe on the credit cards. So you may ask, did I pay off the credit cards? And the answer is no way. I was hooked. I was an investor now. There wasn't a chance I was going to take that money out of the investing account. So that's not completely true because over about the next year, I did gradually pay off the credit card. But the way I did it, none of it came from the investing account. The way I did it is every check I got from New Balance went to either living expenses and I lived at home, so they weren't too bad, or everything after that, I split between the investing account and paying off the credit cards. And the only reason I paid off the credit cards was because I wanted to put more money into the investment account. And I couldn't stand that I had to make that payment. So I figured, let me try to get rid of it. Now, if I were smarter, then at the time I actually would have paid attention to what the interest rate was. But frankly, I don't even remember what it was. I didn't pay attention to that at all. All I knew is that I wanted to put more money in investing, and that was the only thing that mattered. I paid off the credit cards just to get more money to invest. Now, just to finish up that story real quick, my next two investments actually didn't go so well. So I had great success with Wyeth and the options. So I figured I should just stick with the options. And I actually did two different options. I found one, like a week later, I did another one. Bought a call option, and then a week later, I bought a call option for a different stock. I just bought one of each. I figured that with the 1,600, I could diversify, spend about 150, 160 bucks per each one. I can get 10 different stocks in there. Well, each one I had done about 3 months out, and over the next month or two, I didn't really find many other options. I just had those two positions. One stock went down, the other one didn't move much. I forget what the companies were, but as I sat there and watched it, I realized how risky these options actually were. I was throwing away the $300 or so I had invested in these two options. And then I gradually realized that that was much closer to gambling than it was investing. The reasons I had for the stock to move over the next 3 months was fairly minimal. I always had the thought process of being a long-term investor, but I was only giving myself short-term opportunities with the options. So today, I know a ton more about investing than I did back then. So if I were advising myself and I had $1,000 to start with, what would I do? Well, the first thing I would do is I would stick with ETFs. This allows for there to be some built-in diversification. Now, this is important since I didn't really have the money to diversify myself. Now, I remember at the time that I cared for some reason about the number of shares that I bought. I didn't want to buy, let's say, just 3 shares of a $300 stock. So I looked for companies that were trading near the $20, $30 range. That being said, I stuck with 3 ETFs here that are in the $20 range that I would personally stick with if I were doing this today. Now, the first one is called the First Trust North America Energy Infrastructure Fund, ticker symbol EMLP. It's got a yield of about 4%, and they invest in pipeline companies, master limited partnerships, utilities, companies like that. And I thought this was interesting because energy commodities have been down a bit, so I figured that could make an interesting play in 2019. Right now, this ETF is trading at about $23 a share. The fee for this ETF is a bit high. It's almost 1%. I think it was 95 basis points. But for a lot of people, the solid yield helps offset some of that fee. Now, the next ETF is more of a swing at the future. It's called the Global Robotics and Artificial Intelligence ETF, ticker symbol BOTZ. Now, they invest in companies that they believe will benefit from the increased adoption and utilization of robotics and artificial intelligence. They don't have any dividend, and their fee is decent compared to EMLP at just 68 basis points. Currently, BOTZ is trading at about $18 a share. Now, the last ETF I would consider is called the Global X Super Dividend ETF, ticker symbol SDIV. Now, as you can imagine by the name, that they pay great dividends. Currently, the dividend yield is a bit over 8%, and they pay it monthly, which is nice as well. They also have a lower fee compared to the other 2 ETFs at about 58 basis points. Now, the other thing I like about this ETF is that they're global. So it helps because it adds to a more unique style of diversification. If we were to buy other ETFs that were just US-centric, it might not offer the same diversification as a global ETF. Currently, that ETF is trading at about $18.50 a share. Now, the final thing that I mentioned at the start of the video about juicing up my returns actually has to do with options. Each of these ETFs have the options available on them, and I was careful to limit my search to ETFs that did have options because not all ETFs have options available. That being said, I remember when I first started investing and I had a limited amount of capital to invest, I wanted to find ways to juice up my returns as much as I could. Now, options many times appear to be a cheap way to do it. They're a very risky way to do it if you don't know what you're doing, but they can help juice up the returns if you do it correctly. Now, I actually wouldn't recommend doing what I first did when I first started out, and that is buying a call and hoping the stock moves higher. And instead, what I would prefer to do is I would prefer to, let's say, write a covered call To me, that's a much better way to juice up your returns. So in order to do that, you need to own 100 shares. So for SDIV, that's going to cost you about $1,850. Now we only have $1,000, so we put what we can into the account. We buy as many shares as we can, and then the way I would do it from there is every dividend I got, I would try to reinvest in more shares. Don't forget, they have an 8% dividend. Anything I could add to the account, I would add to the account and buy more shares. Once I got to the $1,850, I would go ahead and I would write my first covered call. Now, I was curious what SDIV's options were going for, so I went ahead and checked. And right now, we could sell a covered call that expired in about 3 months for about $40. So if you're wondering, basically what that means is that you would sell somebody the right to buy your shares, your 100 shares, at a certain price by a certain time. In our case, right now the stock was going for about $18.46. So pretend we had $100 shares and our average price was $18.46. We could sell a covered call with a $19 strike price, giving them the option to buy those shares from us at $19. And in return, they would pay us $40 today. Now, in theory, you take that money that they paid you for the covered call and you buy more shares. And if those shares get called away from you in, let's say, the next 3 months, well, you bought it for $18.46, you sell it for $19, plus you get to keep the $40. That seems like a decent move so far. But if they don't get called away from you, in 3 months, you do it again. Do that 4 times a year, and that $40 turns into $160. To me, that's a pretty good way to add some return to ultimately what's called an $1,850 investment. Even though it's possible you get there by only putting the initial $1,000 in and reinvesting those dividends. Now, personally, I like doing this for dividend ETFs and dividend stocks as well, because don't forget, when a dividend gets paid, when the stock goes X dividend date, on the X dividend date, the stock will drop by that amount. So if it pays a 10-cent dividend, drops by 10 cents. Pays a 20-cent dividend, drops by 20 cents. That's great when you're selling covered calls, because if you're selling covered calls, you don't want the stock to get above, in our case, $19. So if it's getting close and then it pays a dividend, not only do you get that cash, but the stock price falls, slightly lowering the percentage that stock will get called away from you. That's the reason with high dividend paying stocks and ETFs, so much of the returns come from dividends and not necessarily the stock moving higher. So that should increase the probability that we can keep turning over the covered calls. So to me, that seems like a win-win. So hopefully you found this interesting, and let me know if you've ever sold covered calls or what you think of the 3 ETFs that I would be investing in today if I were just starting out. And I have links in the description below for videos on dividends and options. And besides that, let me know what you think in the comments below. If you haven't done so already, hit the subscribe button, and I'll see you in the next video. Thanks for sticking around.